Welcome back. That's right. You're watching Traders Corner here on Business Day TV. And at the desk is Garth McKenzie, editor and founder of Traders Corner. Garth, welcome back and welcome to the new year.
Thanks, Bronwyn, and welcome back to you. And let's get the show started. It's our 10th year of Traders Corner. Can you believe it?
I can't believe it. It certainly is a long time to be in the market. And normally at the start of a new year, it's all about New Year's resolutions. There's a real sense of optimism. And yet, as we stand here on the start of 2019, I get the sense that generally we're in for a bit of a tough ride. How are you reading things at the moment?
That's right. It does look as if we're in for potentially a bumpy year. It started last year. We saw volatility beginning to pick up in 2018. And particularly at the end of last year, we saw the market selling off quite aggressively. And there are indications, I think, that we've possibly started a new bear market in the US. A number of the bigger overseas markets have been in bear markets for some time, but the US was sort of the last man standing. It was the strong market, and even that now looks to have faltered and begun to turn down. So we're going to look at that in terms of this week's show and lay the background and the landscape as we see it now at the start of the year, globally and then also locally as well, and paint the backdrop.
Okay, so then let's get straight into it. You've got the long-term weekly chart of the S&P 500, and that's going to give us a sense really of whether we're in a bull or a bear market, right?
Well, that's right. So here we've got the weekly chart of the S&P 500. Now it goes back to 1998. And the reason I've gone back that far is to illustrate where we've had bull markets and bear markets over the last 2 decades, essentially. And if you look at this chart, what is particularly notable to me, and what I think is always a very good read of whether we're in a bull market or a bear market type of environment, is to take this weekly chart and then look at the 50-week moving average and look at the direction of that 50-week moving average. Now, that is the blue line on this chart over here, and you can see how it's very, very clearly demarcated the various bull and bear markets that we've had over that time. So you can see the bull market that went, late 1990s up until 2000, 2001. Then that 50-week moving average began to turn lower, and we had the bear market from 2001 through 2003. Then we had a very powerful bull market up until 2008, and we had the financial crisis, and you'll notice how the 50-week moving average there turned over at the end of 2007. And so you can see it. And essentially, if I then bring in each of the times where that 50-week moving average turned, either from upwards to downwards or downwards to upwards, you can then see where the bull market started and stopped and where the bear market started and stopped. Now that area, those areas that I've highlighted there now in red, indicate where we've had bear markets in the past. All right, so 2001 to 2003-ish was a bear market, 2007 till 2009 was a bear market, and then very briefly in sort of late 2015 we had a very short time span where the 50-week moving average actually began to turn slightly negative, but then what happened was the central banks came in and the Federal Reserve came in with a whole bunch of extra quantitative easing, and that got the markets moving higher again. Now what's interesting is that this 50-week moving average began to turn negative in December last year, which suggests to me that we've begun a new bear market. Now what I want to just look at here is each of those prior 2 major bear markets that we saw. Let's just look at how they started, and then let's compare it to where we stand today.
Okay, cool.
So this is what the beginning of the 2007 to 2009 bear market looked like. Again, it's a weekly chart of the S&P 500, and there you can see that 50-week moving average that I've talked about. Now notice, as the 50-week moving average turned down at the start of 2008, that was the beginning of what essentially was the bear market. You got a big crack in that market at that point into early 2008. It broke below some significant lateral support, and then it rallied back and it went up and it gave a retest of the breakdown area, and it also tested the underside of that 50-week moving average, where it then failed and turned lower again. Okay, so that was a pretty significant turning point that we saw in early 2008 when it reversed down off the underside of that 50-week moving average. Now let's have a look at 2000 to 2003 when that bear market started. So that was in effectively late 2000 when that 50-week moving average began to turn negative. And again, you saw the break below support, the market rallied back up, it failed at the underside of the 50-week moving average, and then it began another leg to the downside. All right, so this is a commonality that we can see in each of these bear markets over the past 2 decades. Now let's look at where we are currently. This is again the S&P 500 weekly chart, and what was very significant towards the end of last year was this break below 2,600. And notice how we had a very sharp sell-off down to 2350. The market has now begun to bounce, and it's had a pretty swift bounce. It's bounced more than 10% off those lows in the last 3 weeks. But there's a lot of resistance here at 2,600 and quite a lot more resistance up at 2,700, which is where the underside of that 50-week moving average will come into play again. Also, if I put on your Fibonacci retracement levels, you can see that your 50% Fibonacci retracement comes in at 2650, and the 61.8% retracement is at about 2730. So my expectation is that if this market follows the same kind of pattern as what we saw at the start of the prior two bear markets, then I would think that this S&P 500 starts to run into a lot of resistance up in that sort of zone where those 2650 to 2700, that sort of area. And if we start to reverse down from there and begin another leg to the downside, then I think it's further confirmation that we are in a new bear market. Also, just once again, I want to reiterate, notice that the 50-week moving average began to turn negative there in December last year, which suggests to me that we've begun this downward momentum that starts a new bear market.
So we're going to have to keep a close eye on whether we're going to see that chart really tell us whether we are in that bear market or not. But given all that's at play, let's maybe look at some of the themes that you think we're going to encounter over 2019. Maybe you can give us 6 of those.
Yeah, so we've got these are probably my top 6 themes of the in terms of the fundamentals that are facing global markets at the moment. So we've got rising US interest rates. We've seen a number of hikes from the Federal Reserve, and there's the possibility that there may be further hikes coming in 2019. It's debatable because the bond market suggests maybe not, but let's see. The indications are still that the Fed may still hike once or twice more. So we are in a rising interest rate cycle in the US, and we combine that with very high levels of indebtedness, and particularly corporate debt, which is a risk for equity markets, I think. We're also late in the economic cycle, both in US and in China. So those are your 2 major economic powerhouses, and both of those are very late in their economic cycles and beginning to show signs of deterioration. Certainly some of the economic data that has been coming out recently has begun to indicate a bit of a deterioration in the economic status of those countries. Quantitative easing is finished in the US, and we're now into a quantitative tightening cycle. So that also is a headwind for equity markets typically, and effectively it's a withdrawal of the liquidity, the steroids that the Fed pumped into the equity markets indirectly over the last number of years. That stimulus is now being withdrawn. The US yield curve, and I'm talking about the 2-year versus the 10-year yield curve here, is beginning to approach zero. If it goes negative, in other words, you get an inverted yield curve, what that has typically indicated in the past is it's been a very reliable indicator of a recession. It's debatable whether the US goes into a recession in 2019 or not. A number of commentators seem to think not, but that the economic growth rate will slow. Yeah. There is, however, a rising risk that maybe in 2020 the US could go into a recession. So watch that yield curve, because it has been a very reliable indicator, particularly if it drops below zero and it inverts. And then volatility began to rise last year, as I mentioned, and that is typically quite common at the early phases of a new bear market. And then the last point is the trade wars between the US and China. That's still a very big theme. Now, look, I understand the US and China are right now busy discussing, and they're hopefully going to try and reach some sort of a resolution in their in trade agreements between now and March, which may give the market some relief if they can come to some sort of amicable solution there, because one would think that from both sides there's a desire to reach some sort of an amicable solution. Yeah. But nevertheless, that is still a very important theme, and if they aren't able to reach some sort of an amicable resolution, that still poses big risks for the global economy this year. Just very quickly, because we've talked about the international market and the international themes, looking at our top 40 locally, which obviously is most important to a lot of our viewers who trade the local market, what's very significant is that last year that break below 49,000 on the top 40 was a very significant technical development, and the market's now been stuck below that level for 3 months really. It does appear as if we've got somewhat of a rounding bottom forming on the top 40 future here. And I would think that there's a good chance that we maybe go back up and retest the underside of that 49,000 resistance again, and then see what happens from there. But yeah, so short term, maybe we could still see a little bit more upside, but it's going to be very interesting to see what happens when the market gets to that resistance point.
Okay.
So that's technically, and then locally, just some of the themes quickly to run through. I mean, we've got 5 top themes here in South Africa that I think we need to be mindful of this year.
Yeah.
Obviously, the election in May, we're going to see a lot of political noise beginning to rise. I mean, there's already a lot of noise, but it's probably going to get louder as the elections approach in May. That'll be interesting. But I think it also could be a bit of a wait and see kind of approach as we lead up to the elections. Then South Africa is at the bottom of its economic cycle at the moment. We're different to the US and China in that respect, where they're peaking, but we're at the bottom. The trouble is that we've almost lost a decade of economic cycle in South Africa. So I'm not sure that we necessarily just start picking up aggressively. The growth rate is still slow, and if there is a global downturn, we will be unable to escape that, I think. So we've got to keep that in mind. South Africa is still vulnerable to a downgrade to full junk status. I think Moody's must very rapidly be running out of patience with us. They've warned and warned and warned. You know, our state-owned entities are still a risk. Eskom's a big risk. The slow growth in the country is a big risk. So I wouldn't be too surprised if at some stage we see a negative outlook from Moody's and possibly a downgrade to full junk status at some stage this year. Then the fourth point is that corporates in South Africa do sit on a lot of cash. You know, part of this last decade, as it were, economic cycle in South Africa is that a lot of companies have not been reinvesting back into the economy. And it's resulted in very, very cash-heavy balance sheets from a lot of corporates. The figures I've seen are somewhere in the order of R1 trillion sitting on balance sheets. So if we do see some economic confidence returning, then one could potentially see some of that money being put to work. Yeah. And then lastly, the South African Inc. stocks probably do represent reasonable value now, but the question is, are they a value trap in a global economic slowdown? So those are some of the bigger themes I see in terms of the local environment.
So it certainly seems like 2019 is going to be a very challenging year, but that doesn't mean we can't make some money for charity. So given what you've outlined, what is the approach and the plan for our portfolio? Well,
look, this year, there's obviously what I've painted here is quite a lot of bearishness. But do keep in mind, things don't just go down in a straight line. Some of the biggest bounces, the biggest rallies that you'll ever see typically happen in bear markets. So we need to be positioned to play that volatility in both directions. So I will be looking to try and possibly look to put some short positions on when we do see these big rallies. I might make use of some option structuring again, as we've done in the past, and possibly do a little bit more shorting this year than what I've done in the past. But having said that, also look for the long opportunities. Look to try and take advantage of that volatility, because the one thing that a lot of volatility does provide you as a trader is a lot more opportunity to make money in the markets. But you do have to get on the right side of that volatility and be specific about identifying those opportunities. So we're going to do our best to try and find those opportunities this year.
Okay, so then very quickly, what are our goals for this year?
All right, so remember we start the year with 2 accounts. We've got 150,000 Rand in a local account, which we will trade with throughout the year. And then we've got $15,000, which we've got in an offshore account. And we will look to trade those accounts throughout the year, see and do the best that we can with it. And then in terms of the goals for this year, it's the same goals I come up with every year, but they're good goals, I think. So first is to aim for 2 out of 3 trades to be winners. We want our winners to be 3 times bigger than our losers on average. And I'm going to look to try and trade 30 times for the show this year. We managed 31 trades last year, and that was pretty achievable. And I think 30 times this year is a good number. It's not over trading, it's not under trading, and I'm sure there should be 30 opportunities for us to try and trade on the show this year.
Garth, you're getting the year off to a busy start as well. You have 3 courses coming up in Johannesburg, in Durban and in Cape Town. Where can viewers go to get more detail on those courses?
Yes, this is my high probability trading course. It's a full day course which details basically the techniques we use to trade the market successfully. Anyone that's interested in attending any of those courses, you can see the dates over there. Please email me, garth@traderscorner.co.za, and I'll send you all the information.
Garth, thanks so much for your time today. Garth McKenzie is editor and founder of Traders Corner.